Hey, have you ever had one of those nights where you're lying in bed, staring at the ceiling, and your mind just won't shut off? It's not about work or some argument with a friend. It's that nagging worry about your credit score. Maybe you missed a payment a few months back because life got in the way, and now you're picturing how it's going to haunt you when you try to rent a new place or buy a car. That sinking feeling, like you've somehow proven you're not responsible enough. I know it well. I've been there myself, scrolling through my credit report at 2 a.m., wondering how a single number can make me feel so small. But here's the thing that hit me like a quiet revelation one day. Your credit score isn't really a judgment on your character or your discipline. It's not some moral scorecard handed down from on high. No, it's a tool designed for profit, mostly someone else's. And once you see it that way, it changes everything. Today, let's talk about that. Let's unpack why we've all been sold this idea that our credit score defines our worth, and what happens when we reframe it as just another part of a system built to make money off us. I remember talking to a friend of mine. Let's call him Alex. He's in his mid-30s, works a steady job in marketing. But a couple of years ago, he went through a rough patch. Lost his gig during a company downsizing. Had to lean on credit cards to cover rent and groceries while he hunted for something new. His score dipped, not dramatically, but enough that when he applied for a loan to consolidate things, the interest rate they offered was sky high. He told me, "I felt like such a loser, man. Like, how did I let this happen? I'm supposed to be the adult here." And that's the trap so many of us fall into. We internalize this number as a reflection of our personal failings, our laziness, our impulsiveness, our inability to adult properly. But step back for a second. Who benefits from us feeling that way? Not us. It's the lenders, the banks, the entire financial ecosystem that thrives on keeping us chasing that perfect score, borrowing just enough to stay in the game, but never quite free of it. Think about how we've been conditioned to view credit. From the time we're young adults, we're told to build good credit like it's a badge of honor. Pay your bills on time, don't max out your cards. Sound advice on the surface, right? But the underlying message is that a high score means you're trustworthy, reliable, a good person financially. And a low one? Well, that implies the opposite. Reckless, unreliable, maybe even unworthy of basic opportunities like affordable housing or a decent job. I've heard stories from people who've been denied apartments not because they couldn't afford the rent, but because their score was a few points shy of the landlord's cutoff. It stings, doesn't it? That sense of being judged by an algorithm that doesn't know your story, the medical emergency that wiped out your savings, the family obligation that meant putting a trip on credit, the job loss that came out of nowhere. We beat ourselves up over it. But the truth is, this system wasn't built to measure our responsibility. It was built to predict and maximize profit for lenders. Let me take you back a bit to how this all started. Credit scoring as we know it didn't just appear out of thin air. It has roots in the mid-20th century when lenders needed a way to assess risk more efficiently than gut feelings or personal references. Enter Fair Isaac Corporation, or FICO, founded in the 1950s. They developed the first widely used credit scoring model in the 1980s. And it caught on because it made lending decisions faster and, crucially, more profitable. Before that, credit was often granted based on relationships. Your local banker knew you, knew your family, and decided if you were good for it. But as banking scaled up, they needed data. So, FICO created a system that crunches numbers from your credit reports. Things like how often you pay on time, how much debt you're carrying relative to your limits, how long you've had accounts open, what types of credit you use, and how many new inquiries you've got. The big one, payment history, makes up about 35% of a FICO score. Miss a payment by 30 days or more, and it can drop your score by 100 points or so, depending on your starting point. Then there's amounts owed, around 30%. That's your credit utilization. Basically how much of your available credit you're using. Keeping it under 30% is the sweet spot, they say. Length of credit history is 15%, rewarding those who've been in the game longer. New credit and credit mix rounded out at 10% each. Too many applications in a short time looks risky. And having a variety of accounts like a mortgage, car loan, and credit card shows you can handle different types. VantageScore, created by the three big credit bureaus, Equifax, TransUnion, and Experian, in 2006, is similar but tweaks the weights a bit. Payment history at 40%, utilization at 20%, and so on. Both range from 300 to 850, with higher being better. Sounds straightforward, right? Like a fair way to gauge if someone's likely to pay back what they borrow. But here's where the profit angle creeps in. These models aren't neutral. They're designed to help lenders identify who'll be the most lucrative customers. A good borrower isn't just someone who pays back on time. It's someone who borrows enough to generate interest and fees, but not so much that they default entirely. Think about it. If you have a perfect score, you might get the lowest rates, but lenders make less profit per dollar from you. If your score's middling, they can charge you higher interest, late fees, maybe even push you into products with penalties baked in. And if it's too low, they might deny you outright, but that just funnels you toward predatory options like payday loans, where the profits are astronomical. The credit bureaus themselves are in on it. They collect your data, often without you even realizing the full extent, and sell access to it. Your credit report is their product, and scores are the value add. Lenders pay for those scores to decide your rates, and the bureaus profit from the ecosystem they've helped create. It's a multi-billion-dollar industry, and psychologically, it keeps us hooked. We chase that higher score like it's a video game level up, applying for cards we might not need, keeping accounts open longer than necessary, all to play by their rules. But who set those rules? Not us. Not even regulators, really. It's private companies like FICO, whose algorithms are proprietary secrets. Now, let's talk about the emotional side, because this isn't just numbers on a screen. I've seen how a dipping score can spiral into real anxiety. Remember Alex? After his score dropped, he started avoiding social gatherings because he felt ashamed, like his friends with their new homes and cars were somehow better at life. Studies back this up. People in areas with lower average credit scores report higher rates of depression and anxiety. One from Johns Hopkins found that in zip codes with poorer scores, folks were more likely to have frequent symptoms, up to 13.7% for depression versus 10.9% in higher score areas. It's not hard to see why. A low score feels like a barrier to everything. Better jobs, some employers check credit, affordable insurance rates, even utility deposits. It triggers that fight or flight response, but there's no lion to run from. It's just this abstract number dictating your options. And the psychology of it is insidious. We're wired to seek approval, to avoid shame. Credit scores tap into that, making us feel personally deficient when things go south. But normalize it for a second. Life happens. A medical bill you didn't see coming. A family member needing help. Rent going up while wages stall. These aren't moral failings. They're realities in a world where wages haven't kept pace with costs for decades. Yet the system frames them as such, encouraging us to blame ourselves rather than question why, say, healthcare debt can tank your score, even if it's not your fault, or why student loans, which many of us took on thinking they were investments in our future, weigh so heavily. It's like the score is a mirror, but a distorted one, reflecting back not who we are, but how profitable we are to the machine. Take a simple example: credit utilization. Say you have a card with a $10,000 limit, and you charge $3,000 for an emergency car repair. Your utilization jumps to 30%, which is the threshold. But if life throws another curveball and you hit $4,000, now it's 40%. And your score dips, not because you're irresponsible, but because the algorithm says high utilization signals risk. Meanwhile, the bank loves it if you carry that balance. They're collecting interest. Or think about payment history. One late payment on a utility bill, maybe you forgot amid the chaos of moving, can linger for 7 years. 7 years. That's longer than some relationships last. It creates this long-tail guilt, this constant reminder that you messed up. But again, who profits? The lenders who can justify higher rates because you're now higher risk. I've thought a lot about this in my own life. There was a time when I was younger, fresh out of college, and I racked up some debt on travel and experiences. Because hey, YOLO, right? My score wasn't terrible, but it wasn't great. And when I went to refinance my student loans, the rate they quoted made me pause. It felt like punishment for living a little. But reflecting on it now, I realize it wasn't about my choices being wrong. It was the system nudging me to borrow more conservatively, to stay within bounds that keep the profits flowing steadily. And that's the reframe. It's not personal, it's business. But here's where things get interesting, the turning point. What if, instead of seeing your credit score as a verdict on your soul, you viewed it as a game, not one you're forced to play forever, but one you can navigate smarter, on your terms? That mindset shift freed me up immensely. Suddenly, it's not about proving I'm responsible. It's about understanding the rules to protect my peace of mind. Because when you detach the emotion, you see how the score connects to bigger things. Financial freedom, less stress over money, more space to breathe. Psychology tells us that feeling in control reduces anxiety. It's why people with a plan, even a simple one, sleep better. And in this case, the plan isn't to obsess over perfection. It's to recognize that the system's profit-driven, so you can make moves that serve you, not just the banks. For instance, realizing that income doesn't factor into your score at all. That myth gets busted quick. You could be a millionaire with bad habits and have a low score, or scraping by but paying on time and have a stellar one. It's about behavior, not wealth. And that levels the playing field a bit. Or the idea that carrying a balance helps your score. Total fiction. Paying in full each month is better. It shows you can handle credit without owing interest, which is the bank's profit center. Once I internalized that, I stopped feeling guilty for using credit strategically. It's like flipping the script. The score becomes a tool for you, not against you. And that shift, it brings a kind of peace. Money stops being this emotional minefield and starts being about choices. Ones that lead to more freedom, like not being tied to high-interest debt, or having options when life throws curveballs. Connecting it to psychology, it's about breaking the shame cycle. We all have that inner voice that says, "You should have known better." But what if we quieted it by acknowledging the system's role? Lenders want us borrowing, spending, generating fees. It's their business model. Your score helps them segment us into profit buckets. Prime, subprime, whatever. But you're more than a bucket. You're someone with stories, setbacks, wins. Reframing lets you decide. Do I play to minimize their profit, or do I let it control me? For me, it meant focusing on what the score enables. Lower rates when I need to borrow for something meaningful like a home or education, without letting it define my self-worth. That changes decision-making from reactive, "Oh no, my score," to proactive, "How can I use this to build stability?" And stability, that's the real freedom. Less worry about bills, more time for family, hobbies, that walk in the park without your mind racing. Now let's get practical. Because understanding is one thing, but applying it calmly is where the magic happens. I'm not here to push some extreme overhaul. No cut up all your cards drama or hustle till you drop nonsense. Just realistic steps that fit into real life, where you're juggling work, family, maybe that nagging back pain from sitting too long. First off, peek at your score regularly, but not obsessively. Sites like Credit Karma or the Bureau's own tools let you check without dinging it. That's another myth busted. Soft inquiries don't hurt. It's like glancing at your fuel gauge. You don't stare at it the whole drive, but you note when it's low. Then, focus on the big levers without overcomplicating. Payment history is king, so set up autopay for bills if you can. It's a simple hack that prevents those accidental lates that stick around forever. I've done it for everything from rent to utilities, and it takes the mental load off. For utilization, aim to keep balances low relative to limits. But don't stress if you go over occasionally. Just pay down when you can. Maybe that means using cash for groceries one week to free up card space. And length of history. Time does the work there. So avoid closing old accounts unless there's a fee eating at you. Mix in a variety if it makes sense. Like adding an installment loan if you're buying a car. But only if it fits your needs, not just for the score. Real life example. My sister, who's a teacher with 2 kids, had her score hovering around 680 after some post-divorce debt. She didn't go extreme. She just started tracking one thing at a time. First, she disputed an old error on her report, a collection that wasn't hers, and it boosted her 40 points. Then, she asked for a credit limit increase on her main card, which dropped her utilization without borrowing more. Over a year, her score climbed to 750, and when she refinanced her car loan, the lower rate saved her $50 a month. That's coffee money, or a movie night with the kids. Small wins that add up to less stress. And she did it without feeling deprived. It was about smart tweaks, not sacrifice. Another one. If you're dealing with high utilization from emergencies, consider consolidating if the math works. Maybe a personal loan at a fixed rate versus revolving credit card debt. But shop around calmly. Don't rush into the first offer. And build that emergency fund gradually. Even if it's $20 a paycheck into a high-yield savings. It acts as a buffer, so you don't have to rely on credit for every surprise. Psychologically, that fund is gold. It gives you that sense of control, reducing the anxiety that low scores amplify. Remember, progress isn't linear. A setback like a job change might dip things temporarily, but consistent habits pull it back up. For families, think about the ripple effects. If your score's keeping you in a high-rent situation because better places demand higher numbers, small improvements could open doors, literally. Or if work stress is tied to commuting in an old car with payments you can barely afford, a better score might mean refinancing to something manageable. It's not about becoming rich, it's about easing the daily grind. And if debt's overwhelming, talk to a nonprofit credit counselor. They're not there to judge, just to help map a path. I did that once, and it was like unloading a backpack I didn't realize was so heavy. The key is realism. No one's expecting you to hit 850 overnight. Aim for good enough. 700 or so opens most doors without the perfection pressure. And forgive yourself for past slips. They're data points, not definitions. This approach turns the profit-driven system to your advantage. You borrow less impulsively, pay less interest overall, build equity in things that matter. It's calm motivation. Knowing each step lightens the emotional load. As we wrap this up, I want you to take a breath with me. In, out. That credit score? It's just a number in a game rigged for profit, not a measure of your value. You've got stories behind every digit, triumphs, tough breaks, quiet resiliences, and recognizing that the system's about their bottom line, not your character. That's empowering. It lets you step back, make choices from a place of clarity, not shame. You're not alone in this. Millions feel the same weight. But shifting how we see it? That breeds hope. Not the flashy kind, but the steady one. Knowing you can navigate, improve, find more peace. Progress over perfection. That's the mantra. One on-time payment, one lowered balance, and suddenly money feels less like a boss and more like a tool. You deserve that calm, that space to enjoy the non-financial parts of life. A laugh with friends, a quiet evening with family, that sense of, I've got this. Thanks for spending this time with me. If this resonated, drop a comment. What's one thing you're reframing about your score? See you next time. Take care.